Hello. It fundamentally changed the tax compliance landscape for businesses in Kenya. But the Finance Act 2026 just took that to a whole new level because it provided KRA for the first time a statutory framework for using information it already holds to construct, calculate, populate, and assess your tax position, all while Section 56 of the TPA remains intact. So forget about the single-sidedness of the very active income and expense validation regime that choked businesses filing income tax returns this last tax season. Get used to this because it is the new normal. And it is such a critically pivotal point in the history of tax enforcement that there is a dire need for businesses to rethink their tax compliance strategies. Businesses must understand should understand how this shift poses a new kind of tax risk and possibly other business risks than majority have dared to plan for. So let's talk about what has changed beyond the implementation of ATIMs, mainly the information architecture that has been quietly built around the taxpayer step by step to never realized before data-rich, data-driven tax administrative machinery in Kenya. For years, the model for tax compliance in Kenya was simple. You close your books, you calculate your tax, you file a return, and KRA might eventually come and audit you. That was based on the assumption that your tax return was the first time KRA was seeing your numbers. But then, from January this year, KRA began validating the income and expenses declared in tax returns against data it already has, removing the discrepancy discovery from being an eventual possibility to a real-time event in which discrepancies are flagged automatically. Understand that this makes complete administrative sense. So there is absolutely nothing inherently wrong with the system working this way. So let's be clear about that. But what happens to you, the taxpayer now, who is living the reality of this architecture, which frankly is now rooted far deeper than most taxpayers care to imagine, as was evidenced in the last tax season? That chaos that most taxpayers lived through in January to June, it was because of a data gap problem. Actually, 3 problems stacked on top of each other that have persistently emerged under the new tax system. What data gap? The first is simply the difference between what actually happened in the business and what KRA system can see and attribute to you. This is a gap that may have come because a supplier didn't transmit an invoice, or because of timing mismatch, leading to some of your expenses not having been captured by the system. The second is the reconciliation difference, and this one is on you because it is the difference between what your accounting system captured and what you can actually tie back transaction by transaction to KRA's data. For instance, yes, you have a trial balance, but can you reconcile it transaction by transaction to ATIMs or to withholding tax certificates or any other record that KRA may have? And third, it's the evidence gap, and this is the gap that actually decides disputes, and it is the difference between what a business knows to have happened and what it can prove happened at a level of a single transaction. Meaning, increasingly, the question is no longer, did this expense happen? To serve as evidence, the question you need to ask is, can you prove this specific transaction happened, connecting the amount, the supplier, the payment, and the accounting entry directly to it, which is far higher than just saying, here are financial statements or here is the bank statement. So going forward, any successful tax compliance strategy must start with solving this data gap problem. And to interrogate just what such a strategy must take under consideration, let's look at what the Finance Act 2026 actually added. 1, the Act introduced a new Section 29A to the TPA that now expressly gives the KRA authority to issue an assessment based on information drawn from a list of sources. For example, information submitted under Section 35 of the income tax, tax deductions under Section 37, information under Section 5A of the KRA Act, information submitted through the electronic system and TPA, Section 23A, information under Section 24A, information obtained through inspections, information obtained through audits, and information submitted to the data management and reporting system under Section 59A, and then information under any written law. If it was not clear before, it is now statutorily provided for. KRA could source information from wherever to trigger an audit, to counter your evidence, to calculate your tax, to determine your income limit. Your return is no longer the starting point for any of these. 2. Amendment to Section 75, which is a monumental principle to how tax returns are filed. Now, Section 75 expressly allows KRA to generate a pre-populated tax return on your behalf, independently of what accounting information you might have kept. And although you get a chance to amend it, it nonetheless completely shifts the starting point of self-assessment. You no longer are building your return from your own version of events. You're starting from KRA's version of your year and simply deciding whether you're going to agree with it. And also remember, if you fail to respond or amend the pre-populated return within the provided timeline, that becomes the default return, and good luck overturning that. Lastly, amendment to Section 89, which on the surface appears to give a breather on what the law, the law now recognizes that the electronic system can malfunction, and for that, it provides a leeway for KRA to waive penalties and interest where system error leads to a liability. But remember, that failure, that error has to be raised, it has to be established, and KRA has to accept. And the larger burden of proof through all this still sits on you. Now, put these provisions together with Section 56 of the TPA, which places the burden of proving a tax decision incorrect squarely on the taxpayer, and Section 51 of the TPA, which gives you only 30 days from the notification to lodge an objection. And what you get is not isolated amendments. It is a concrete structure of a monstrous information architecture around the taxpayer, completely surrounded. So bringing all this together, this is where it lands. While self-assessment has not disappeared, the information environment around it has fundamentally changed. What it now actually is a data-conditioned self-assessment, because increasingly you are making the call inside a system where KRA got there first and where the machinery for turning a mismatch into an assessment is now low. So what can you do? Obviously, you are already ETIMS compliant, and that's the baseline. But if you are serious about mitigating exposure to this certainly foreseeable tax risk, you need to do more, which is the whole essence of this chat. First, understand the real shift. Compliance no longer starts when you close your books. It starts the moment a transaction happens, because that's the moment KRA's version of events silently begins. This requires you to move from a reactive compliance, where you explain yourself out of problems that have already been flagged, to a defensive compliance. Then you can start with this for reconciliations, running continuously, not once a year. First, your books against ETIMS. So, does your accounting ledger actually reconcile with your electronic invoice data? 2, your purchases against your supplier's transmission. So, does your books say what your books say you bought match what your supplier actually transmitted on your PIN? And number 3, your income against that party data. So does your declared income tie back to, for example, withholding tax certificates and other information records that KRA already holds? And lastly, your return itself against underlying evidence. So can every material figure in your file return be traced back transaction by transaction to a source document? And on top of that, you can maintain an exception register containing things that don't reconcile. For example, documenting, for example, the particular transaction that doesn't reconcile, the amount and the counterparty involved, say for instance your supplier who transmitted data late or to a wrong PIN, and keep all relevant evidence. This way, if that transaction ever becomes the trigger for an assessment, you don't want to start investigating. You want to already know the problem with that transaction, and you will have evidence that actually can survive the kind of scrutiny that sinks so many cases. So stakes have never been high. And with the burden of proof still statutorily and squarely on you, even when you're right, and eventually KRA's data is the one that was wrong, it costs a lot. It costs staff time, it costs legal fee, tiring document retrieval, and sometimes, as has been a reality for so many taxpayers, years of litigation that can still end against you. So the gap between being right and being found right now pose a new kind of risk for businesses. So close the gap proactively. Thank you.